Welcome back to StockAnalytics.ai, the podcast that breaks down complex earnings reports into actionable insights. I'm your host, Anthony.
And I'm Cleo, your lead analyst. Wells Fargo's Q2 2025 earnings are just out, and here's what you need to know.
Today, we're diving deep into Wells Fargo's second quarter earnings, dissecting the numbers to understand what it means for investors. The banking sector has faced some headwinds recently, so I'm particularly interested in seeing how Wells Fargo performed.
Well, let's start with the headline numbers. Revenue came in at $20.822 billion, a modest 1% increase year over year. EPS, that's earnings per share, how much profit the company made for each share outstanding, hit $1.60, a solid 20% jump compared to Q2 2024.
So revenue growth is slow, but earnings per share are up significantly. That seems like a mixed bag. What's your initial take, Cleo? Was this a strong, weak, or mixed quarter overall?
It's definitely a mixed quarter. The slow revenue growth is a point of concern, but the 20% EPS growth is encouraging. Their net margin, which tells us how much profit they keep from each dollar of revenue, came in at a healthy 26.4%. This suggests they managed expenses effectively. Wells Fargo highlighted efforts to increase fee-based income as a driver of this performance, which we'll explore further. They also repurchased a significant chunk of common stock, $3.0 billion worth, to be exact, which can boost EPS. The lifting of the asset cap, a major regulatory hurdle they've been dealing with, is also a significant positive development.
That asset cap removal is definitely a big deal. It's been hanging over them for a while. Okay, so a mixed bag with some positive signs. Let's dig deeper into the numbers. Cleo, let's break down the revenue picture. Where did the growth, or lack thereof, come from?
The earnings report breaks down Wells Fargo's performance into 5 key segments. Consumer banking and lending, their largest segment, saw revenue of $9.228 billion, a 2.5% increase year over year. This suggests continued, albeit slow, growth in their core consumer business. However, 2 of their other segments, commercial banking and corporate investment banking, experienced declines. Commercial banking revenue fell by 6.1% to $2.933 billion, and corporate and investment banking revenue dipped by 3.4% to $4.673 billion.
Those declines in commercial and investment banking are concerning. What's driving that?
While the report doesn't specifically detail the reasons behind these declines, it's likely related to the broader economic environment. The Management's Outlook and Highlights section mentions current and future economic and market conditions as key factors influencing their performance. This suggests that factors like a slowdown in global economic growth, as mentioned in the Outlook, may be impacting these segments.
That makes sense. What about the other segments?
Wealth and investment management revenue was essentially flat, growing just 1% to $3.898 billion. Interestingly, the corporate segment saw a massive 125.4% jump in revenue, reaching $0.559 billion. However, it's important to remember that this is a much smaller segment compared to the others, so even a large percentage increase has a relatively smaller impact on the overall revenue picture.
Right. So the modest overall revenue growth seems to be driven primarily by the consumer banking and lending segment, while the other segments are experiencing a mix of stagnation and decline. Now, let's talk about profitability. How efficiently is Wells Fargo converting sales into actual profit?
As mentioned earlier, the net margin came in at a healthy 26.4%, which shows they're keeping a decent portion of each dollar earned as profit. Unfortunately, the report doesn't provide specific figures for gross margin or operating margin. However, given the healthy net margin and the emphasis on expense management in their highlights, we can infer they are managing their costs effectively. We'll look for more details on this in the full financial statements.
So while we don't have all the profitability details, the available data suggests a positive picture on the cost management front. What about cash flow?
The earnings report doesn't provide specific figures for operating cash flow or free cash flow in this summary. From operating cash flow, the company pays for its capital expenditures to arrive at free cash flow, which is a key metric for investors to watch for. However, the report does disclose that shareholder equity sits at $183 billion. Shareholder equity represents the residual value of the company's assets after all liabilities have been paid off, essentially the net worth of the company from a shareholder perspective. This gives us some insight into the overall financial position of Wells Fargo.
Okay, so while we're missing some cash flow details, the shareholder equity figure provides a general sense of their financial health. Cleo, what's the outlook for Wells Fargo? What guidance did management provide?
Well, management provided a pretty extensive outlook, highlighting both potential opportunities and challenges. They emphasized the importance of navigating the current and future economic and market conditions, including factors like geopolitical matters and potential slowdowns in global economic growth. They also acknowledged regulatory matters and the potential impact of new regulations on their business. These are all important considerations for investors.
So, a cautious outlook given the uncertain economic environment. Anything else stand out in the guidance?
They also discussed their focus on increasing fee-based income, which ties back to their revenue performance. They mention the importance of managing credit risk effectively, given the potential for loan losses in a challenging economic climate. And, as we discussed earlier, the lifting of the asset cap is a significant development that they highlighted as a pivotal milestone.
So, Cleo, given everything we've discussed, what's your final takeaway for investors on Wells Fargo?
This was a mixed quarter for Wells Fargo. While the EPS growth is encouraging and the removal of the asset cap is a major positive, the slow revenue growth and challenges in certain business segments are areas of concern. Investors should closely monitor the broader economic environment and how it impacts Wells Fargo's performance in the coming quarters. The company's focus on expense management and generating fee-based income will be critical for navigating these challenges.
That's all the time we have for today's earnings analysis. Thanks for joining us on stockanalytics.ai.
Remember, this discussion is for educational purposes only and not personalized investment advice. Be sure to do your own research and consult with a qualified financial advisor.
Subscribe to our channel for more institutional-grade earnings analysis. Until next time.